following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And welcome to the Volatility Viewpoint. This is indeed the portion of the show where Don and I sometimes bring on a guest, and sometimes Don and I discuss some of the interesting and unusual topics that are floating around the world of volatility. And this is actually we have a good opportunity this week because Don, as we discussed in the intro, just came back from his mega session with the Morgan Stanley analysts last week. And he had a chance to get some firsthand input, some firsthand questions, some firsthand commentary from people who are either slightly versed in options, or I think for the majority of them, that was their first exposure to the world of options. And we've touched on this show in the past briefly on the topic of skew. And I think now that Don is ripe from his classes in Morgan Stanley, it's a good time to get back into this topic because there are a number of questions surrounding it. We receive a number of questions on this program on a regular basis about skew. And I know, Don, you had your hands full when you got to that chapter in your presentation about skew, and not just the different types of skew like investment skew or commodity skew or vice versa, but also some of the reasoning why and that behind this phenomenon and why it actually occurs. You know, it's a fun topic. I've discussed it a number of times on various articles and webinars, and it's fun because there are some concrete reasons behind it, and there's also some subjective ones as well. I think we can get into both of those. But since you are fresh from the Morgan Stanley educational marathon, we'll let you start off with your some of your reasons you think of why skew exists and the different types of skew that we're seeing out there in the market right now.
Well, of course, the interesting starting point for all of this is that prior to the crash, there really was no skew to speak of, at least in the form that we know it today.
No, it's an observed phenomenon. We didn't know it until it hit us in the face.
So we kind of touched upon it in previous shows where prior to the crash, you really had a kind of a flat one-vol-fits-all below the market options, above the market options, puts, calls. And there was a kind of a slight upturn at the very extremes, very far out of the money calls or puts, and something referred to as the lottery effect. I'll touch upon that in a moment. But in any event, when you connected all the dots, if you will, you had what looked like a smile, and it came to be known as the volatility smile. And the literature still kind of mentions that, even though, as I kind of ironically say, that on October the 19th, 1987, the smile was wiped off the face of options probably forever. So it was replaced with this, at least in equity, and we can talk a little about the shapes of other ones, but at least in equity with this asymmetrical smirk or skew, if you will, where the out-of-the-money puts and the in-the-money calls, the options below the market, are at progressively higher implied volatilities as we go further below the current levels, and just the opposite to the upside, where increasingly higher strike prices seem to give you increasingly lower implied volatilities. And so you have that kind of asymmetric pattern. And the question, of course, on everybody's mind is why? And there are numerous answers, and some of them, as you said, are subjective, some of them are objective. I've always kind of argued that from a strictly mathematical point of view, absolute, just trying to apply any types of formulas, distribution patterns, justification for prices, that I find it very hard to justify the way this current implied volatility skew looks if you're just going to invoke purely mathematical concepts. And my strong feeling is one of supply and demand that drives these prices even to this day. and I'll touch upon it in a moment. But there are other suggestions, and I'm going to kind of offer them and then kind of rebut, if you will, or try to explain why I don't think they're necessarily valid explanations. So the first one is this lottery effect. And the lottery effect simply states that if you can get a tremendous payout for something, a huge multiple, basically pay an eighth of a dollar or a quarter of a dollar for an option that's way out of the money, and if something untoward happens, wind up making millions if the option goes to $20 or $30, that anybody is willing to pay a little bit more for this lottery ticket. Everybody who goes and pays $1 to buy a lottery ticket and hopes to make multiple tens of millions of dollars doesn't bother to figure out whether the government or the state that runs it is keeping 50% and that the true price ought to be 40 or 50 cents, but we're paying $1. So, in implied volatility terms, we're overpaying for this. But that doesn't stop people from going out and buying their lottery tickets every week. So the concept there is simply that, so if you pay a little bit more, if I pay 20 cents for the option instead of 10 or 15, what the heck's the difference if I can have this huge payout? And there's nothing wrong with that argument, except for the fact that if that were the sole explanation of the skew, you'd wonder why it's not two-sided, why there isn't at least some semblance of more symmetry to it. Because although it's true that we've seen markets go down 23% in one day, but we've never seen them go up 23%, at least in the equity markets, then it might be reasonable to say that the jackpot, if you will, or the big payoff is slightly skewed to the downside, and studies show that downside volatility, when it's separated from upside volatility, is slightly greater, but with the emphasis on slightly. So my point of view there is that, yes, the lottery effect could explain higher implied volatilities for extremely out-of-the-money options, but it ought to do so more in a two-sided fashion, such that if there were a huge increase in the underlying, you could have a lottery effect there as well.
Yeah, you'd think that I've heard a lot of different propositions put forth for why skew exists, but the lottery effect is not one I've really heard that often, at least recently, because you'd think just looking at the skew graph, it would instantly disprove that notion, because you're right, it isn't the skew graph, at least when it comes to equity/investment skew, is asymmetrical. You're not seeing this increase in the wings on both sides. You're seeing the decrease in the call volatility, obviously, and the corresponding increase in put volatility. So that would imply that everyone is betting on the lottery tickets to the downside, which would be a unique phenomenon given the fact that everyone in the market usually tends to lean quite long. And unless they're all hedging and over-hedging quite a bit, I don't know if that lottery skew really, lottery hypothesis really pertains.
And I agree with you, of course. So again, I'm not the one who invented it, but rather am commenting on it, and I absolutely share your viewpoint. And a second related one to that I discussed somewhat, and that I come to a similar conclusion about, is that maybe the model that we're using in order to derive these implieds in the first place, because don't forget, implieds don't exist in a vacuum on their own. You have to first price an option and then work the Black-Scholes model backwards to back out an implied volatility. What volatility did we have to use in order to arrive at that price? So it's a kind of a backwards process where an implied doesn't exist without first having an options price and then using the Black-Scholes model kind of backwards from the way it was intended to be used, where you input a volatility and then get as an output the price of the option. So another argument is that the model is imperfect. And we know that the Black-Scholes model is imperfect for a number of reasons. It assumes a constant volatility. You enter one volatility, and then you price the option for its life as if that volatility is going to stay the same over the entire course until the expiration. And of course, we know that that's not true. And we've talked on the show about the volatility of volatility and how much it moves around, especially in the short term. And yet, when you go to an option pricing model and they say stick in a volatility, that's one number that you provide as if that number were going to stay the same all the way through. In addition, you know that in the Black-Scholes model, you take a look at it and it says it's the normal, the area under the cumulative density curve, the normal of, and then there's an expression D1 minus the normal of, another expression D2. And when you look at that, there's an assumption of this log normal distribution of stock prices. So a second argument is that we kind of know from observation that that's not really true either, and that stock prices, at least again, with equity, exhibit what we call in a very fancy term leptokurtosis, or fat tails, and that the outliers on both sides, yet again, that's the key, up and down, that there's more area under the curve than the normal distribution would allow. And so, again, it's an argument for perhaps raising the prices of these out-of-the-money options as an accommodation to the fact that we have fat tails in the real world and not the perfect, normal or log normal distribution. But again, my rebuttal to that would be quite simply that this, again, is a two-sided phenomenon, and that when you look at these fat tails, it's in the plural. You find that they're on both sides, and that both to the upside and the downside, you find more outliers and more area under say 3 standard deviations up or down than would be predicted by the classic normal distribution or bell curve. So again, it's a valid phenomenon, but in my viewpoint, it doesn't describe or doesn't adequately explain the shape of the skew, because yet again, as you just pointed out for the lottery effect, it ought to be two-sided, and it isn't.
Yeah, I'd imagine. I can't imagine. Obviously, I know you're just running these down for our listeners, and like you did for your students last week. But I can't imagine any serious trader at this point would look to the old fat kurtosis, because again, the equity skew asymmetric, so you need something that could account for that asymmetric style of shape. Of course, I'm sure a lot of the premium sellers in our audience would love to have fatter tails on both sides of the skew, because that would just mean a bonanza for them as they continue to hit these out-of-the-money options with great fervor and vigor. But it seems that is not the case, at least not for now.
So then there's one more, and then I'll kind of get to the supply and demand part to wrap up this segment. And the one that I think you will admit, Mark, that you have heard, because I certainly have.
I will admit nothing.
Okay. is also, in my opinion, somewhat flawed, and I'll explain why. And that is that people say, well, that volatility might look high. We might be at 20, or in fact, we're at 25 right now for the at the money as volatility has been spiking. But as you go below the market, you start to see 28 and 32 and 35, and you might even hit 40 if you go down far enough. And so the argument goes, it's not my argument, but I'm repeating it. Yeah, I can understand that, because if we were to drop today to those levels, and because they're down 10 or 15 or 20%, and my gosh, if we had a meltdown and the market were down 10% today or 15% today, by all means, those options would be trading at those implied volatilities, if not even higher. So we're justified in saying that if we go 10% or 15% below the market, because if we had this, catastrophic event, that would be the level of volatility at the time. Well, that may very well be true, but it sure as heck does not explain in my book why you would take that volatility that you think we would be trading at the moment and trade it every single day of your life as if we were actually already there without discounting it at all for the probability or the likelihood that we could ever be there. I think I once calculated earlier in the year, so listeners can check my math. But since the crash, October 19th, 1987, I don't think it's quite 9,000. I think it's about 8,700 days have gone by. Okay. Now, that may not be trading days, so that may be something more like calendar days in the year. But I think that if you go back and check, we probably had something like about 6,000 trading days since the day of the crash, somewhere in that neighborhood, okay? And to imply, no pun intended, to imply that each and every one of those 6,000 days that we go out there, that we should be thinking, today's the day that we're going to be down 10 or 15%. So we need to trade these options at 40 because after all, if we get there today, we'll be at 40 or 50 volatility. Well, I mean, at what point do you stop thinking that way? At what point do you stop waking up in the morning and going to work on day 6001 and say to yourself, you know what? We probably won't be down 10% today. And I probably shouldn't be trading those options at, 40 or 35 implied volatility. Nobody wants to seem to calculate in the probability or the likelihood that we could be at 40. So now if you give me a weighted average, 40 with what probability? 1 in 1,000? 1 in 2,000? Now multiply out and do an expected number or an expected value, and I don't think you're going to come up with 40 anymore. So that's just not an argument that sits well with me. I'm just not willing to buy that one.
Yeah, that one's almost like a battered wife syndrome. You keep getting hit every day expecting something different, I suppose. So, of course, given the rate that many market-making firms and trading firms are shuttering their doors these days, maybe there are more adherents to this philosophy than you think, Don.
Yep, well, it's very possible. And so, of course, you've got to get some explanation, and the one that I've always subscribed to, just because it seems by far the most logical to me, is supply and demand, and is the fact that something is worth what somebody else will pay for it. And we know what a debacle portfolio insurance was at the time of the crash, where firms were selling this concept of trying to dynamically replicate the protection that a put option would give by instead selling off futures contracts as the market would move, and if it would drop, you'd sell some more. And we discussed that at another time as well. And of course, what happened on the day of the crash was that they didn't get off all of those sales, according to their wonderful schedule, because the futures dislocated from the cash, and all of a sudden down 20% without all of the intermediate sales that were supposed to take place, and tens of millions of dollars were lost. And so this concept of dynamic put replication was discredited and kind of disappeared from the landscape. And as a result, we went back to the good old-fashioned have the protection in your pocket ahead of time, have these sleeping puts and insurance puts, and don't try to protect your car from a crash as it's going over the cliff, but have your insurance policy in hand ahead of time. So these puts below the market simply became the gold standard for equity portfolio protection. And the sellers, who might have been burned on the day of the crash, basically said, fool me once, shame on you, but fool me twice, shame on me. And they resolved to never sell those puts at those lower implied volatilities again. So to my way of thinking, it is a supply and demand issue. It's not something that can be justified from any mathematical or rigorous analytical point of view, but simply one of expedience where the owners of equity and the natural, inclination is for portfolio managers to be long stocks and to go out and have to occasionally protect. And they do so by buying these puts, and the sellers say, aha, you can't do it any other way, and I'm going to make you pay through the nose for this. And the final piece of the puzzle is, as it gets expensive to do this, the buyers, the needers of the insurance say, how can I possibly cheapen this up? And the answer is, well, maybe I look above and I sell some calls, try to offset the cost of this premium by taking in a little premium to offset the pain a little bit, if you will, the price of the protection. And so was born of the crash this skew where the below the options driven by the puts got more expensive, and the calls that were being sold to offset the cost got cheaper, and I think it's going to be forever thus. I don't think we're going to see any change. I never thought that would have been the case 25 years ago, but I definitely think it's the case now.
Yeah, I don't see us going back to the smile anytime soon, as much as some people might like it.
The pre-crash smile is wiped off the face of options forever.
There you go. You're very fond of these dire pronouncements, like the smile being wiped off, or the options die a little every day. Of course, they make for great show headlines, titles. So I love them. And the way I've always discussed skew when this topic comes up, and it comes up quite a bit, as you could imagine, is I approach it from a fundamental and a psychological perspective. And they all seem to key around that factor that you pointed out, that the bulk of market participants are at any given time long the market. They're long the underlying. So that causes several effects. On the fundamental side, I mean, anyone who's ever spent any time in any large equity option pit knows that the bulk of the order flow coming in from the large customers, the institutions, what have you, because most of them are long, let's say a Microsoft or an Intel or a Google, these long institutions are dumping covered calls all the time, so therefore crushing the upside skew because they're trying to generate income from that long portfolio. At the same time, they're looking to hedge their downside risk with that long portfolio, hence they're buying up the downside puts, so that tends to give the skew that asymmetric tilt that we like to know, where the upside calls have a decreased level of implied volatility and the downside puts have an increased level of implied volatility. And of course, the opposite side of that, the fundamental side of that, which would be the psychological aspect of that, of course, also comes from the fact that the bulk of market participants are long the market. So when we rally, there is a generally reduced level of fear and or uncertainty in the marketplace, and when we crash, when we move to the downside, there is generally an increased level of fear and or uncertainty because people are suddenly incurring losses in their portfolio. So I think when you merge those two factors together, the fundamental and of course the subjective / psychological, then you have what we've witnessed for the last 20 odd years, or the 6,000 plus trading days that Don has referred to, the good old asymmetric equity skew that we all know and love and or hate.
I agree with every word that you said, Mark, and you just kind of wonder whether or not, for, 14 years, they introduced options in 1973, and then along came index options, and basically you just wonder whether or not, people for those 14 years were considered to just be kind of like trading in the dark ages, or, were too dumb to figure out or understand any of this. And I kind of say that a little bit sarcastically, whereas I agree with absolutely everything that you've said. It's sort of like it took the crash to actually put this idea into people's minds, as if the exact same concepts didn't exist prior to 1987. We had portfolio managers long the market, and we had put options long before, well, not long before in a relative spectrum, but, 10 years before the crash, and yet this didn't occur to anybody. So the question remains whether it's not somewhat overdone or not, but we don't want to beat a dead horse here.
I mean, no, it's interesting. I mean, of course, you predate the crash in the options markets. You have a dual perspective. I came into the options market post 1987, and I think anyone who did that, there is definitely a demarcation in the world of options where people who came in afterwards, and the resulting just upheaval that has occurred in the technology and of course the knowledge and understanding of how the underlying and the options perform in these extreme events, that people do kind of consider the pre-1987 days, the pre-Skew days, they look a little bit askance, like, oh, those are indeed they are the dark ages. I've heard quite a few people refer to them as that. Perhaps not quite as dark as the days when there were no puts, when people were just trading in the ether, as it were. But still, there is definitely, if you look at options education and options training, there is a demarcation where here's the days back in the dark ages, and here's the days after this event where we started to get it a little bit more, and we started to understand what the heck was actually going on. Maybe we still don't have a full handle on it, obviously, but perhaps a tighter grasp than we did prior to 1987.
Yep.
All right, and that was a fun discussion. I think we could go on about Skew for quite a long time, but we do have to close out the old volatility viewpoint.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.